Carillion, one of the construction companies working on the HS2 London to Birmingham rail line, is racing to refinance its business after issuing its third profit warning in 5 months and suffering a collapse in share price. Shares in the company, which is at the heart of several major building projects in the UK, were suspended 7 times on Friday after the shock update to the city that it would breach the terms on its existing lending at the end of the year. The shares crashed 60% when the stock market opened on Friday, to their lowest ever levels, and were still down nearly 40% near the end of the day's trading. At this price, about 25p, the shares are barely a tenth of the 240p level seen at the start of 2017 and values the company at just £120 million. Carillion has debts of £1.6 billion and analysts expect the company, known for its work on expanding the main stand at Liverpool's Anfield football ground and its ongoing development of Battersea Power Station, to have to ask its lenders to swap their debt for shares. The company employs 30,000, 2/3 of them in the UK, and has contracts with the Highways Agency, Network Rail and the Ministry of Defence. It is building hospitals including Merseyside's Royal Liverpool and also has a support services operation which has maintenance contracts for buildings. The government, one of its major customers, said it was being kept informed. We remain supportive of their ongoing discussions with their stakeholders and await future updates on their progress, the Cabinet Office said. Nicholas Hyatt, an analyst at Hargreaves Lansdown, described the situation as an ongoing horror show. In July, the company issued a profits warning and announced the departure of Chief Executive Richard Howson. In September it stunned the city again with another profits warning. Some sort of recapitalization was inevitable, but a possible debt for equity swap, with debt even higher than the group had anticipated, is probably as bad as anyone would have guessed, Hyatt said. The company said the latest warning to the city was caused by delays to its attempts to sell off some of public-private partnership, PPP, deals, a delay to a significant project in the Middle East, and a squeeze on profit margins in some of its support services contracts in the UK. Carillion aims to arrange the refinancing before April, when the new chief executive, Andrew Davies, is due to start. Interim Chief Executive Keith Cochrane said constructive dialogue was underway with lenders and shareholders. Cochrane has been leading a program to cut debt, reduce risks and scrutinize the management of each one of its hundreds of contracts. Whilst we continue to target cash collections, reduce costs, executive disposals and focus on delivering for our customers, it is clear that significant remain and more needs to be done to reduce net debt and rebuild the balance sheet. Union officials called for talks with management and said that thousands relied on the company for work through subcontracts and agencies. Bernard Macaulay, Unite's National Officer for Construction, said members needed a warts-and-all prognosis of the company's long-term future.